Hello, I'm Sarah Allen and welcome to The Pitch. Are the best days for developed market bonds over? Should you be looking at emerging market bonds instead? Today I'm joined by VanEck's Eric Fine to talk through just that. Eric, welcome.
Thanks, Sarah.
So to begin with, have investors missed the boat on returns when it comes to developed market bonds?
For developed market bonds, what returns? Right? They've been a disaster for 20 years. The developed market bonds are the Eurozone bonds, which have had two crises. What were those crises? A lot of debt paying you nothing. Developed market returns, yield curve control in Japan. How is that a developed market issue, right? That's financial suppression. You're supposed to escape financial repression. That's why Japanese money flows out. Our money's already out. So what returns? And I think that's been the big problem is most investors are standing on ground they don't understand. They've been told treasuries, the dollar, the global ag, US investment grade bonds should be the bulk of your portfolios and you're never supposed to worry about them. And for 20 years, they've generated volatility and poor returns.
So why should investors be looking at emerging market bonds instead for the best opportunities?
Because they've been the best performers for the last 20 years, because the reasons they've performed are still there. Low debt pays you more. And number three, they're winners from the new geopolitical configuration. They're trading with each other more, which reduces costs, lowers the neutral real rate, if you want to call it that. And also, when you see headlines like UAE agrees with India to accept INR for oil, not dollars for oil, or Brazil agreeing with China the same, or Saudi Arabia agreeing with China the same, what do you think the Saudi or UAE central bank does with that INR and CNY? Well, over time, they don't want a pile of cash. They invest in those bond markets. That's exactly why Saudi Arabia is up to here in treasuries. And so what this means is other central banks are buying my EM bonds as reserve assets, and they're selling treasuries, which means there's secular demand for these bonds. Their financing is sorted. Central banks are not just buying gold and selling treasuries, they're buying EM bonds. And that's a fundamental that DM doesn't have. DMs, who are they borrowing from? They're borrowing from their own central banks. When I was in school, that was a major no-no. We have a financial crisis and all of a sudden it's a legitimate policy tool.
How can investors balance the risks of investing in emerging markets?
Number one, access all the opportunities. A lot of institutional investors for decades have gotten interested in EM because it answers a basic question. We want low debt and we want to get a coupon on our bonds. And what institutional investors initially did was, okay, we get that, we want low debt pays you more, but what's the highest beta? Oh, local currency. Let's do it all in local. And local doesn't always work. Others said, well, you know what, it's safer, let's do it in dollars. Dollar-denominated bonds don't always work. And so we created the world's first actively managed blend fund that says local is attractive, dollar-denominated bonds are attractive, corporate bonds are attractive. Find the best in that group so that you're always finding the best in EM, and therefore you're not vulnerable to these top-down concepts like the dollar's going down, which is not really clear what it means in EM, but access the full set of opportunities. Find blend managers that can find the best in EM and don't confine them to say, well, we want you to make money in EM, but you can only do it in this little world.
Can you share some examples of how you're investing in this space?
Sure. Brazil, very high real interest rates, very hawkish central bank. Inflation's about the same as it is in Australia, right? Brazil has almost the same inflation as Australia. Interest rates are 11%. And it's a big exporter that is up to its neck in dollars. They have more dollar reserves than they do dollar debt at the central bank level. Very unusual to have countries like that. So that's one great example of a country with an independent central bank that's focused solely on inflation and that's paying you while you're sitting there, paying you double, triple what the yields are in the developed market countries with similar inflation and nowhere near the strong balance sheet that Brazil has. Now, Brazil has problems. It arguably does have too much debt. So, Brazil's not out of the woods, but that would be one example. Another interesting opportunity. Now, this one's shorter lived, but it's an example of the alpha space in EM. We've actually had China be one of our top 5 performers for the last 3 years in a row, when China to most has been this disaster bond-wise. The first thing we did is we didn't own it when it blew up, right? Investment-grade Chinese corporate bonds priced at par weren't attractive on our process, so we ignored it. It fell apart. So that was, not owning it was. But the reaction was so overdone, and the closure of funds was so overdone, that real value was generated. And so we found very small, diversified opportunities that were little engines that could. So that's another great example. Everyone's negative on China. And so by definition, if you can find cheap bonds, so you have your fundamental, and everyone hates it, we know what Paul Tudor Jones says: when you have the technical and the fundamental, you size it up. Now, we can't size it up too much in China because it is risky, and because we do have constraints that are linked to our benchmark. But there can be great opportunities, even though I think the China story may become uninvestable. I completely get that. Sanctions are likely coming, and I think they're inexorably stopping. Tariffs are coming, but that doesn't mean that you can't find opportunities. That's a more time-limited one, but those are 2 examples. Brazil, kind of a more traditional, obvious, headline one, but even China, which is arguably has some bad, events coming down the pipeline. You're able to do some real positive. Let's say positive damage, or let's say positive returns for your funds with small diversified positions that are totally uncorrelated. When China's going up or down, it has nothing to do with the Fed, has nothing to do with stocks, nothing to do with oil prices. It's just whether those things are cheap and whether they're going up, and it's really uncorrelated, which is obviously huge for investors.
Thank you so much for sharing your insights today, Eric.
Thank you, Sarah.
If you've enjoyed this interview, please subscribe to Livewire Markets. Thank you for watching.